This is PMFA Perspectives. PMFA Perspectives is an ongoing series dedicated to helping you achieve financial success through informative dialogue on topics central to wealth management. We believe you can achieve your goals when you have the proper tools. On a frequent and ongoing basis, we compile and illustrate selected economic and capital market information to help educate you on issues relative to those you may be facing. This podcast is based on our monthly publication, Market Perspectives, which is available for you to read at pmfa.com/pmfa/perspectives. Our key commentator is Jim Baird, partner and PMFA's Chief Investment Officer. Here's Jim Baird.
Thank you for joining us for the October edition of the PMFA Perspectives podcast. Little different format today as I will be going solo, as it were. But a lot going on in the market, and particularly here over the last few weeks, a number of things worth touching on. At this point, it seems like September 30 and talking about third quarter numbers and the results from the month are almost ancient history because so much has happened in the intervening period. And we'll talk about that a little bit. But September in and of itself, even without some of the volatility that we've seen in the month of October, notwithstanding, September in and of itself was a bit of a down month. Equity markets globally were down, led lower by the higher risk areas of the equity markets traditionally, with emerging market equities down almost 7.5% for the month. And within the U.S., smaller companies down over 6%. And that took small caps back into negative territory for the year. They've kind of bounced around, been above the zero mark, and then back down below more than once. So as of the end of the third quarter, negative territory for the year. Conversely, even though larger company stocks were negative for the month, there's really no part of the U.S. equity market that emerged unscathed. There's no question that the disparity in returns between large caps and small caps in the U.S. has tremendously favored larger company stocks. Through the end of September, the differential in performance was close to 15%. So a big difference there. Internationally, looking to developed markets negative as well. So, as I already mentioned, pretty broad negative returns across the board. On the bond side, it was a similar result, modestly negative returns for the month, but bonds are still in positive territory on a year-to-date basis, and taxable bonds surprisingly so. As we've discussed in prior podcasts, we've seen longer-term rates come down, and that actually has become even more noteworthy here in October. So, when we look at the events of this month, stocks clearly have sold off. We've seen a significant surge in volatility, really an extension of the losses that were experienced in September. But beyond just negative days in the market, it's been volatility as a whole. We've seen 8, 9, 10 days probably now as I look at the screen here with moves in excess of 1%. We had gone quite an extended period without any kind of substantial volatility in the equity markets. And I think we had said more than once, certainly, that the market was overdue for probably a little bit of volatility. Well, we've seen that now. And even today, as we record this, it's a volatile day, but it's an up day in the market. And that's part of volatility. That's part of the difficulty in terms of trying to time the market, in that some of the market's best days historically have fallen right in the midst of down days as well. We saw this back in 2008 and the 2009 timeframe, you may recall, where obviously in a downward market, still a lot of positive up days. So trying to time getting in and out can be treacherous and certainly not something that we would recommend. So we did see a little bit of a sell-off here, but even so, I would argue that that's normal. In a typical year in the market, you would expect to see that. So that's what I think we've seen here in October. I think when you look at the fundamental underpinnings from an economic perspective, certainly the news is still relatively good. Broadly speaking, growth for the third quarter, while we don't have the first estimate yet, is broadly expected to come in probably at about 3% growth, give or take a little bit, which is certainly solid. A little slower than the second quarter, but that's to be expected. And expectations moving forward from here are still pretty good in the United States. It's a very different story when you look abroad, though. And Europe in particular has been one of the catalysts for the return to volatility in the markets as investors have recognized that risk. And the weakness in the European economy certainly is a concern. The question in part will be, will that bleed over to the economy here in the U.S.? And what impact will it have on American companies? When you look at larger U.S. companies recently, earnings and revenue numbers have been, in many cases, revised downward. Some have still disappointed. It's been a bit of a mixed bag. But one of the concerns would be particularly related to U.S. multinationals and the potential that they feel the negative impact of slower sales overseas, recognizing that many of these very large companies derive a substantial portion of their earnings and revenue from outside the U.S. So that's been a source of concern and uncertainty as well. What will the impact be? So plenty to think about, obviously, for investors. And then finally, I would note the emerging Ebola concerns here in the U.S. Many of these things, there's no way to tell what the final result will be, but it's seeds of uncertainty that have been planted. And after a long period of relative calm in the market, you kind of see those things coming to a head and investors becoming a little bit more jittery. The real question in my mind, though, isn't how far might the market fall if it continues to fall, or what will the outcome of the obvious concerns about Ebola now being in the U.S., what will the outcome of that be? The real question is, as an investor, what do you do with that information? And as all of you know, we start with the standpoint of being strategic asset allocators. We start from the standpoint of looking at our clients' long-term goals and helping them to develop a policy and an asset allocation strategy that will allow them to navigate any market conditions. There's nothing that we're experiencing today that is different than what we've experienced at some point in time in the past. And we always talk about the likelihood that it will happen again. The question is always, when will the next recession come? When might the next bear market come? What will the catalyst be? It's very difficult to say, but what we do know is over the long term, investors are well served to remain committed to their strategy and use these opportunities, if you will, to rebalance their portfolios, to reinforce that buy low, sell high discipline through rebalancing, and sometimes, in certain circumstances, to look for opportunities to harvest tax losses that can be applied against other gains. So from a tax efficiency standpoint, you're able to manage that a little bit better. So what's the advice to investors today? Certainly don't panic. And the good news is I don't think we're seeing that in the market today because we've seen some updates in there. We've seen things stabilize. And I think we've seen investors recognize this for what it is, which is a market correction that happens from time to time, but we don't think it's a repeat of 2008. And we certainly wouldn't advise investors to deviate from their strategy at this point in time. Secondly, beyond don't panic, go ahead and reaffirm your strategy. Make sure that you're still in the right place. And given your goals, given the resources that you have, your tolerance for risk, that your portfolio is appropriately positioned. Third, and I already hinted at this a little bit ago, and that's to rebalance. When you see stocks fall in value, that is a good time to perhaps make some purchases at the margins and get back towards your target allocations to the extent that you've seen your portfolio move meaningfully. And finally, as I mentioned, evaluate opportunities from a tax perspective. As you come in here at the end of the year, certainly many investors who have experienced gains might have some gains that were harvested as well earlier in the year that would result in the payment of tax. Mutual funds as well may be paying distributions here in the coming months. So it's really appropriate and important here as you head towards the final months of the year to take a look at your tax situation and evaluate whether there's any steps that you could take to minimize or reduce your tax bill. So in closing, I think it's important to note that we cannot predict what the market will hold in the coming days or weeks, and arguably neither can anyone else. We do believe strongly that investors should avoid the urge to deviate from their strategy or try to market time in the thought that they might wait for better market conditions or sunnier weather, if you will, to buy back in. Almost always, that's a losing strategy. By the time you feel confidence in the market, that the worst is behind us, the market has already moved. It's that recovery in prices often that makes investors feel better. And if you're trying to time your investments around when you feel better after the market has moved, you're going to miss out on that upside. So stay the course. Don't allow yourself to give in to that human emotion of fear or at the other end of the spectrum, greed, when markets are running very high. Keep your eyes on the horizon. Stay committed to your strategy. In short, our best advice would be to stay the course. And with that, we'll thank you for joining us for the October edition of the podcast. As always, any feedback that you have or any questions that you'd like to pose to us are welcome. You can contact us at our website, wealth.plantmoran.com.
Thank you for joining us for PMFA Perspectives. Be sure to visit pmfa.com/PMFA/perspectives and read our monthly publication, Market Perspectives. And be sure to visit the PMFA Perspectives website every month to hear each new installment of our podcast. PMFA Perspectives, copyright 2013. The following is an important note relating to these comments, which were recorded on October 17, 2014. Past performance does not guarantee future results. All investments include risk and have the potential for loss as well as gain. Data sources for peer group comparisons, returns, and standard statistical data are provided by the sources referenced and are based on data obtained from recognized statistical services and other sources believed to be reliable. However, some or all information has not been verified prior to the analysis, and we do not make any representations as to its accuracy or completeness. Any analysis non-factual in nature constitutes only current opinions, which are subject to change. Benchmarks or indices are included for information purposes only to reflect the current market environment. No index is a directly tradable investment. There may be instances when consultant opinions regarding any fundamental or quantitative analysis may not agree. Plant Moran Financial Advisors publishes this update to convey general information about market conditions and not for the purpose of providing investment advice. Investment in any of the sectors mentioned herein may not be appropriate for you. You should consult a representative from Plant Moran Financial Advisors for investment advice regarding your own situation. Investment recommendations provided herein are subject to change at any time. Those recommendations provided herein are provided for informational purposes only and are not provided as a recommendation to buy or sell any one security or allocate to any asset class. Past and current recommendations that are profitable are not indicative of future results, which may in fact result in a loss. Please contact PMFA if you are interested in receiving a list of all past specific investment recommendations for the preceding 12 months.